as stocks and crypto markets have begun to signal widespread investor capitulation, key indices have broken some key support levels, potentially triggering forced sales. With long-term market and inflation trends indicating lower asset prices, inflationary forces skew the GDP compensation share back toward labor and away from asset owners. MicroStrategy came under scrutiny as the SEC has attempted to analyze their heavy Bitcoin balance sheet. This revolves around how gains and losses are reported during Bitcoin price fluctuations. While MicroStrategy is not in the crosshairs of the SEC per se, at least for legal action, just the contact alone caused a massive sell-off of the tech company's stock. So definitely something to keep an eye on. SEC finding the perfect time to target crypto holders. I'm going to dive into some metrics today to show you the extent of this crash. So I am all about the data. I am not here to hype you up. I'm here to give you the real story. So a lot of this started, the Central Bank of Russia is demanding a blanket ban on crypto mining and crypto trading. So the Russian central bank compared Bitcoin to a pyramid scheme and demanded an immediate ban on its use domestically. So within the sovereign state of Russia. The central bank also, the Russian central bank also warned crypto could pose a risk to the financial sovereignty of the nation. So this is adding fuel to the fire. So since Russia has become, more recently, has become the third largest Bitcoin mining hub, the central bank's demand for a blanket ban is definitely fueling this dump. And we've got several economic indicators happening all at once, and so the risks to investors are severe. However, it is hard to say how long the correlation between crypto and the stock market will continue. But since we do not know what that is, I wanted to cover a few things with you guys today. There is ample reason to believe that the immense equity valuations and debt level growth since 2008, and particularly since 2020, has reached its end. There are also many other signals of an economic slowdown that will cause many people and corporations to reduce spending and sell assets to free up cash and reduce risk exposure. Given the high margin debt levels, option market activity, and the fact that many indices are now below their support levels, continued losses could easily result in rapid declines. In my opinion, given these factors, it would not be unsurprising to see significant daily losses akin to those of early 2020. Further, given historically extreme equity valuations and rising interest rates, as well as the positive stock-bond correlation, I believe the total downside for the S&P 500 could easily be 50% or more, with more considerable losses for the most overvalued technology stocks. The global economy has witnessed record margin debt and credit card debt recently, and if you combine this with lower investor cash allocations, reduced personal savings, hiked gas prices, surging food prices, and parabolic inflation, all these factors indicate negative retail investor liquidity flows. So coupling this weak consumer liquidity and poor business sentiment, all of this, the business sentiment is becoming more fiscally conservative, plus falling real incomes, poor Q4 bank earnings, rising initial claims, and to top it all off, China's economic issues. So, by most measures, stock market valuations have been above the long term norm since 2014. Of course, investors that have avoided the market since then have missed out on the tremendous bubble that has been growing since then. The truth is that the real reason for the unending growth in the US stock market over the past 7 years has been because of super low interest rates and money printing from the Federal Reserve, pumping hot air into the bubble balloon. Basically, low interest rates directly push up all companies' fair discounted cash flow, particularly growth stocks, since they have more significant future cash flow growth. Low rates have also allowed companies to easily take on debt to pursue development, cheaply refinance higher rate debt, and in many cases, borrow money to repurchase equity shares, thereby creating a artificial EPS growth. So let me jump into a little bit of this stuff here, these charts, and I want to paint a picture for you, and this is very important. If you are an investor, you really should listen to this message. The easy money era, which has existed since 2009, has created many dislocations in the market and within corporate balance sheets. Given the sharp rise in interest rates following the 40-year high inflation rate, it appears that this era is officially ending. As this occurs, I suspect many of these dislocations will be brought back to normality, likely forcing bond and stock valuations to go significantly lower. Over a century of S&P 500 valuations have been inversely correlated to the inflation rate. Let me say that again. Over a century of S&P 500, the stock market valuations have been inversely correlated to the interest rate. In this first chart, the inverse relationship is far from robust. We can see a general pattern. Inflation, represented by the orange line, and that is labeled U.S. Consumer Index, was high following World War II, and the stock market valuations were depressed. So if we look here, U.S. Consumer Index, inflation was wicked high, up around $36, and the S&P was right at the bottom of its lowest low. We can see that the price action in the stock market changed by the 1920s when inflation slowed a bit and valuations surged on the Fed's prolonged reluctance to raise interest rates. Then the bubble popped shortly after their belated decision to raise rates, causing the Great Depression. From roughly 1950 to 1970, inflation returned to ultra low levels post-war, allowing valuations to rise again. Then, in the mid-70s, inflation began to get out of control, causing the Fed to hike rates and causing the stock market to fall back down to low levels. So today, we currently have low cash allocations, high margin debt, and high valuations, particularly after accounting for total debt. As such, if stocks or bonds decline, then many investors will likely be forced to sell positions to raise cash to meet margin requirements. In many cases, such situations can create catastrophic, cascading declines in assets. Another major factor that has benefited the stock market since 2020 has been the tremendous influx of new retail investing activity. In fact, mass closures of businesses and stimulus checks through the COVID pandemic may have directly promoted stock prices as it resulted in people having more savings than could be put into the stock market. Indeed, the percentage of total household wealth invested in the stock market has surged to all-time highs of 41% since 2020. However, the saving rate is now below pre-COVID levels as many people struggle with negative real wage growth, forcing them to reduce spending. And we could see that picture painted here. We have U.S. real average hourly earnings in blue, and we have the savings rate in orange. As real wages are falling and saving rates are plummeting, many people do not have free savings to put back into stocks. Combined with low investor allocations, high margin debt levels, record credit card debt, Fed tapering, and rapidly rising short term rates, essentially leaves no source of domestic liquidity that can go into stocks. So there is ample reason to believe that the immense equity valuations and debt level growth since 2008, and particularly since 2020, has reached its end. There are also many other signals of an economic slowdown that will cause many people and corporations to reduce spending and sell assets to free up cash and reduce risk exposure. Given the high margin debt levels, option market activity, and the fact that many indices are now below their support levels, continued losses could easily result in rapid declines. In my opinion, given these factors, it would not be unsurprising to see significant daily losses akin to those of early 2020. Further, given historically extreme equity valuations and rising interest rates, as well as the positive stock bond correlation, I believe the total downside for the S&P 500 could easily be 50% or more, with more considerable losses for the most overvalued technology stocks. You can see that the post 1970s changes better in this chart. So, since there is a higher quality data based on the sum of the stock market capitalization compared to the total U.S. debt, and that includes both public and private, and we also see GDP on this chart. U.S. debt and GDP fell as inflation and interest rates rose in the 1970s to early 80s, building up the stock market bubble. This is termed the Great Moderation Era. So, and we could see the stock market in this blue line steadily climbing higher, higher, higher as the consumer price index and the market yield on U.S. Treasury securities continued to fall lower. From what I can tell, and based on this data, the total stock and bond market value compared to GDP is the most accurate overall measure of valuations. Essentially, the total gross domestic product, or the total income, must support the financial markets through interest, dividends, and similar payments to asset owners. When that total value of assets is extremely high compared to GDP, more money flows toward asset owners must take place, and it must come away from workers or from the labor market. This can be seen directly through the share labor to capital compensation ratio, which has generally shifted from labor toward asset owners since the 1970s. This greed has been abounding as large asset holders sucked the life out of the labor force. The thing is, when interest rates are below inflation, asset prices can easily rise without forcing more money to flow away from the labor market toward asset owners. However, when interest rates do rise, a significant portion of the GDP should flow toward capital or asset owners as companies, governments, and people continue to pay higher interest rates. So, we discussed the impact of interest rates on capital flows in the economy. Basically, as interest rates are low, asset prices rise, practically artificially pumping them up like a balloon. And right now, the portion of the GDP that is in the hands of labor or workers is already at extreme lows and cannot go any lower, especially considering the growing labor shortage we are in. So, what does this mean? It means if interest rates rise, asset prices must decline to keep a constant level of capital labor share of the GDP. The pendulum must swing back to workers. Now, while all this sounds complicated, we know when home prices rise, we know that home prices rise when mortgage rates drop, especially to the degree that monthly payments remain flat. Similarly, home prices must decline as mortgage rates rise to keep the monthly payments constant. So, real interest rates will need to increase as we enter another long-term period of goods and labor shortages. This shift is already pushing asset prices down through these labor versus capital dynamics. Considering the US is very likely in a persistent supply-driven inflationary era, the Federal Reserve will not likely support the market if it crashes. A similar example happened after the Great Depression, when it took the stock market over 2 decades for its inflation-adjusted price to return to pre-crash levels. This evidence demonstrates the high probability of poor stock and bond market returns over the coming decade. While the inflation spike has increased this probability, this is still a long-term outlook. Let me show you why.